If you're feeling the pinch with interest rate increases, you're gonna want to hear this tax strategy. I don't think a lot of investors understand, and that's usually because they haven't got the right accountants working on their team, is a thing called a PAYG tax variation. Now, a lot of investors have considered selling just simply due to the pinch on their cash flow. It's costing them a lot more to hold the property. They can't necessarily wait until the end of financial year to lodge their tax returns and then get a big lump sum of cash. They need the cash on a weekly, bi-weekly or monthly basis, depending on how they're paid. What a PAYG tax variation does, if you're likely to get a $10,000, $15,000, $20,000 tax return at the end of financial year, a tax variation will essentially give you the ability to claim back that tax in your weekly, bi-weekly or monthly pay packets. So instead of waiting for $20,000 in July or August the following financial year, you'll get say $300 or $400 per week back in your net pay, which essentially just makes it way easier to hold the property as opposed to you having to fork out money every single week as a negatively cash flow property and then claiming it back at the end of financial year. Now, let's say you've got a $400,000 investment loan, the rental income on that property is about $19,000, interest payable on that property is $27,000, and you've got some expenses in there, say 1% of the property value, so you've got $4,000 worth of expenses. You've got a negative cash flow of $12,000 per year or $230 a week. So that's $230 every single week you've got to pay to be able to hold this property. Now, if you multiply that out by 2 or 3 or 4 or 5 properties, you can all of a sudden see where this can become $1,200, $1,300, $1,500 a week of negatively cash flow properties, which for a lot of people can be challenging to hold.